everyone, and welcome to the first ever Skipton Insight podcast. I'm Olivia Charlesworth, and today I'm joined by two of our in-house experts, Gareth Smith and Ben Smith. Hi guys.
Hello.
Hello.
We're here to talk about the new tax year. When it comes to your savings and investments, a more tax-efficient portfolio could make a big difference to your financial future. And with that in mind today, we're going to discuss some of the rule changes that are coming in that you might need to know about, such as pension, ISA and dividend allowances. Obviously, the tax treatment of your investments does depend on your individual circumstances, and it could change in the future. And just before we begin, I need to remind everyone that the information we're discussing in this podcast is just for guidance only. So if you are looking for a specific advice, we do recommend that you speak to a financial advisor. Okay, so let's start with a couple of changes, or in some cases a lack of change, in allowances that will take effect from the new tax year. It's been announced that the dividend allowance will reduce from $5,000 to $2,000, and at the same time the ISA allowance will remain at $20,000. So Gareth, what impact could this have on our customers?
Well, Olivia, the reduction in the dividend allowance is an interesting topic and something that definitely prompted some questions from our customers. Is this something you've seen in your team, Ben?
Yeah, definitely. So in my team, we've had a few questions about the dividend allowance. From my point of view, it was only introduced in April 2016, so it is strange to see such a big change in the allowance in such a short period of time.
I think it might be good at this point to explain to customers what dividends are and how the allowance works.
Yeah, so when you invest your money into an investment fund, you generally become entitled to receive a share of any income that's generated. This is generally known as a dividend. The allowance allows for some of these dividends to actually be paid tax-free. And once you exceed this allowance, then the dividends can become taxable at either 7.5% if you're a basic rate taxpayer, 32.5% if you're higher, or 38.1% if you're an additional rate taxpayer.
Yeah, so let's take an example of a customer in receipt of a 4% dividend from their investments. Last tax year, when the dividend allowance was set at £5,000, it would mean that a customer could have had an investment outside of an ISA of £125,000 before they exceeded the allowance, whereas after the reduction to £2,000, with the same 4% dividend generated, it would now take an investment of just £50,000 before the allowance is exceeded. This would mean that a higher rate taxpayer, who only last year could have received £5,000 of dividends tax-free, could now see nearly a £1,000 tax charge should they receive the same £5,000 dividend in the 2018-19 tax year.
And are there ways that customers can beat this reduction and minimise the tax they pay?
Yeah, there certainly are ways to reduce the tax, and through seeking personalised financial advice, a customer could consider a number of different areas. However, in general, the first thing is to consider using the annual ISA allowance, as any dividends generated within an ISA will not be subject to personal tax. I know, Olivia, you've already touched upon the fact the ISA allowance has been frozen at £20,000. Many of us have become accustomed to seeing the ISA allowance gradually increase nearly every year, particularly over the last decade. So it has come as a bit of a surprise that it's been frozen at £20,000 for the new tax year. However, it should be remembered that it was only last tax year that we saw the allowance increase substantially from £15,240. It's no question that the ISA allowance remains a valuable option, and this is only strengthened following the reduction in the dividend allowance, as it will allow more customers to shelter their investments from tax.
Yeah, and just following on from what Ben said, it's really important to note that these allowances are just for individual amounts. So if you're in a relationship, you could actually increase the ISA allowance to £40,000 or the dividend allowance for £4,000 by structuring your investments correctly. So from a tax planning perspective, if you do see your assets as being joint, it's worth considering how you hold these investments to make the best use of the allowances available.
Yeah, and another thing to consider is that potential returns for investors are not generated from dividends in isolation either.
Yeah, depending on how the money is invested, returns could be generated from capital growth or even from interest. Both of these have their own tax-free allowances as well. So you've got the capital gains tax allowance and the personal savings allowances available.
Yeah, and that raises another interesting point around the personal savings allowance, particularly when we consider the low interest rate environment that we're in at present.
It definitely does. The personal savings allowance offers an additional tax-free band of £1,000 for basic rate taxpayers, £500 for those at a higher rate, and offers nothing whatsoever for additional rate taxpayers. Anything above that will generate tax, and that becomes payable at your savings tax rates. With interest rates currently as low as they are, it can take only a small increase in interest rates before we see a number of customers actually exceed this personal savings allowance.
Yeah, and just touching back as well, we've mentioned the ISA already. It's worth pointing out here that any interest that's generated within an ISA will also not be subject to any tax as well.
Yes, so I think the main thing to take away from this is that basically anything held within an ISA wrapper will be free from personal tax as always, regardless of how it's generated.
Yeah, exactly, and that as a benefit on its own is great, but also considering wrapping money within the ISA as early as possible every tax year also leaves less invested in a taxable environment and gives investors more chance of their income falling within the various different allowances that are available to them.
Okay, so let's move on to pensions then. The pension freedom rules introduced in 2015 changed the landscape for many of our customers because for the first time they had the flexibility to access their pension savings however they wanted to, and whilst this came with valuable benefits, it did also come with some complexities, and there are a number of allowances that we need to think about. Some of these allowances have made the headlines again, so let's just get your thoughts on the money purchase annual allowance. If you can explain to everyone what it is and how it works.
Yeah, so for starters, I think it's best to take a second to explore a couple of areas in that. So if we look at what is meant by money purchase, what the annual allowance is, and the tax benefits that are associated with a pension. If we initially consider a money purchase pension, or you may also know this as a defined contribution pension scheme, these pensions build up a value by investing your contributions, these could be both personal and employer, into a fund which will hopefully continue to grow up until the time you take benefits in retirement. Some examples of these could include personal pensions or stakeholder pension plans. With regards to the benefits of the pensions, well, when you pay into a pension you generally get 20% tax relief automatically from the pension contribution. So every £80 you pay in, the government will top it up by an extra 20, take your total contribution to £100. If you're higher or additional rate taxpayers, you'll be able to claim further tax relief by completing a self-assessment tax return. Then on withdrawal from a pension, you're generally entitled to take 25% of the accumulated value, tax-free, with any remainder subject to income tax.
Yeah, and those tax relief benefits and the tax-free cash on withdrawal are really valuable, and therefore the amount you can pay into a pension are limited to the higher of your annual earnings or £3,600. So the normal annual allowance for pensions is £40,000 per tax year, and in some cases this can be carried forward from the 3 previous tax years. This is quite a complex area, where the summary of it is that if you've got high enough earnings, you could potentially contribute or have contributions made on your behalf of up to £160,000 into a pension.
Yeah, now coming back to your original question, Olivia, regarding the money purchase annual allowance. Well, it was originally introduced alongside the pension freedom rules and was intended to counter against an individual using the flexibilities available to access the pension and then reinvest that back into a pension to receive further tax relief. To avoid this from happening, the money purchase annual allowance was introduced, initially set at £10,000. However, last tax year they introduced a cut in that. This has been backdated to April 2017 and reduces this further to £4,000. This is quite a significant cut from the standard annual allowance.
And it's important to understand as well that this reduced allowance will not apply to everybody, even if they are in receipt of pension benefits.
Yeah, that's right. So the allowance will only impact individuals who have accessed their money purchase pension through taking advantage of the new flexibility rules. So again, I don't want to get into the more complex technical areas of it, but some of the more common types of this would be people who have utilised UFPlus or Flexi Access Drawdown. Any individuals who have taken their pensions through the pre-existing routes, such as an annuity or from a defined benefit or final salary scheme, should not be impacted by the reduced allowance.
And what would be the implication of a customer exceeding the allowance in a case where they are limited?
Yeah, so again, this can be quite a complex area and does involve a bit of a calculation. However, the implication would be that any tax relief that has been granted will need to be paid back as a tax charge. In addition to that though, any amount that you've paid into the pension will continue to remain in the pension and potentially be subject to income tax on exit. This could leave a customer in a worse position than they would have been if they'd considered the alternative investment options from the outset.
Yeah, and it's really important that customers are familiar and have considered the available allowances and the tax on exit before they actually consider investing in this vehicle.
And the lifetime allowance, that has seen some more positive news. It was announced that the lifetime allowance will increase in April this year. Again, can you explain to everyone what the lifetime allowance is and also the significance of the increase?
Okay, so the lifetime allowance is a limit on the value of payments you can receive from your pension pots without paying an additional tax charge. The allowance was set at £1 million for 17-18 tax year, but it's set to increase in line with inflation to £1,030,000 from April 2018.
Yeah, and although this might not seem a significant increase on the face of it, it is a positive step. And it's really important to consider that there's been a general downwards trend over the last 7 years. Back in 2011 and 12 tax year, the lifetime allowance was actually 1.8 million.
So whilst £1 million sounds a lot, it's not outside the realms of possibility that a customer would exceed this over their lifetime, particularly when we think of those who are starting out their careers and we're paying into a pension over a number of years. Additionally, many customers are turning to pensions as an investment vehicle in order to take advantage of the tax reliefs available. This has meant that in addition to the pension saved during their working life, there are potentially significant lump sums being placed under a pension wrapper.
And again, what would be the consequences if a customer exceeded their allowance?
Well, the consequences of exceeding the lifetime allowance can be quite considerable. The first thing is that any amount in excess of the lifetime allowance, you're not entitled to a 25% tax-free cash lump sum. In addition to that, you'll actually be subject to a charge of up to 55%, so that can be quite a hefty charge to pay on those pension benefits.
So I certainly hope that the increase continues over the coming tax years, as over time this could reduce the number of customers that will be impacted by the lifetime allowance, and it will allow for more money to be invested into a pension and to take advantage from the tax reliefs available.
Yeah, and just to follow on from that point, the government have made it quite clear that they are looking to increase the lifetime allowance. They've set it to increase in line with CPI each tax year, so we should see this increase each tax year going forwards.
Okay, I think we can safely say we've talked enough about tax for now, so we'll leave it there. Thanks to Gareth and Ben for sharing their thoughts.
Thank
No
you.
problem.
As this is our first podcast, we really welcome your feedback on any topics you'd like to hear about, and if this format worked for you. You can leave comments on the Knowledge Centre article where this podcast was downloaded, so do get in touch. Until next time.